You were listening to chartingwealth.com for Wednesday, the 18th of May, 2016. The markets continue to move in the direction of the big charts. We saw the crossover originally occur on the iShares Dow Jones U.S. Total Market Index Fund. IYY is its symbol. It is what we always look at first. It is the total market crossed over going down back on the 28th on our two-day chart of April, the 28th of April. We saw that followed by 6 more days of down movement, and then the market slid sideways for 4 days and then started its downward move again on the candle closing on the 16th. And then we're in the first day of a 2-day candle when we ended the markets on the 17th as we go into the 18th. Where are we? Well, we have a 2-day trend line that's drawn. We are following that. The market was down overall 0.90% for the day. What do we see on our 4-hour chart? We see that the 4-hour chart has crossed back over again, going down. The entry point could have been either on the 13th, actually the morning of the 13th. Yes, the morning of the 13th, well, really into the afternoon of the 13th. Then, of course, it did pop back up again, but it never moved above our 2-day trend line, and then it popped back over. Now, those of you who did not get in the afternoon, of course, we don't have this signal confirmed yet because this candle has not closed. As we move throughout the day on Wednesday, if you can find a good entry point, that would, of course, be the time to get into an inverse fund. If you wish to get into one that tracks the whole market, it's probably easier as we move into the S&P 500 to talk about SH, which is one of the inverse funds we talk about quite a bit. Now, again, the caveat here is we are not a stock calling service. We are talking about doing virtual trades for you to practice and learn. This is not investment advice. We never bill ourselves as doing that. We don't bill anything. We're an education firm. So thank you so much for paying attention to that. That is extremely important. We want you to learn how to do this, learn how to read a chart, develop your own way of doing things. So much about what we do is personalized to us, to the time that we can devote, to the knowledge that we develop, to the way that we like to do things, to the kind of charts that we wish to use, the indicators and such. We are simply giving you a model that you can then turn into your own. This is personalized to you. So do that. Start learning what we do, practicing, and then develop your own way. Now, we crossed over going down, as we said, in the afternoon on the 4-hour chart, going down. A lot more down movement throughout the course of the afternoon than it ended up. We have a huge, probably 1 1/3 times longer down wick than we had actually in the down movement throughout the course of the afternoon, or a Hinkin Ashi type candlesticks. Now, let's go back, and I would note this though, that the derivative oscillator is still in the positive. Now, we're going to move on to the S&P 500. I will note for you before we leave IYY, we have a diverging MACD from the signal line. We also have a growing derivative oscillator. I love using our derivative oscillator along with the MACD, along with our Bollinger Bands, along with our trend line. Working on a book for you right now, and I've just been studying again so much of why we do things the way we do, how it works for us. And we can tell, looking at the Bollinger Bands, how much the volatility has decreased. The tighter the Bollinger Bands get together, the less volatility you have. The further apart the Bollinger Bands are, there's much more volatility that's existed in the market. As the market starts to flatten out as far as price movement goes, we see the Bollinger Bands pull in, because that's really what they are. They're volatility bands. Okay, enough teaching for right now. We're going to go back to the S&P 500 at this point on the 2-day chart. What do we see going on there? Well, the S&P 500 crossed over going down again, like the total market did back on the 28th of April. Drifted down for several candles, then sideways, then started moving down again. We had the derivative oscillator heat up throughout the course of the day, of the first day of this 2-day candle, and the MACD and the signal line have diverged further from each other, which is always good. When they start coming together, you know they're getting ready for a crossover to move in the opposite direction. So continue to always pay attention to those things. Now, let's look at what's happening on the intraday chart. We had lots of questions in the morning. We had what's called a doji, or a spinning top. What we have in the morning's more like a doji. We had the crossover in the afternoon. Now, interesting, total market had a positive derivative oscillator. The derivative oscillator on the 4-hour chart for the S&P 500 is down, which makes us feel much better. We always want to have a negative derivative oscillator if we're looking at getting into a trade. So if you did not get in the afternoon, look for possibly getting in a down move in the morning. That is on the morning of the 18th. And again, be aware, if you haven't already listened to the weekly review and forecast where we cover possible news, market moving events from the news, do listen to that if you haven't already done so. It's still available at the website and also available on iTunes. So we had a crossover going down. Again, lot of down movement that the bears pulled down. The bulls were able to push back up. And again, for those of you wondering, what are the bears? What are the bulls? That when we say the market is bearish, or people are short trading or shorting the market, that means they're pushing the market down or expecting the market to go down. The bulls are the ones that are out there driving the market up or going long. So we saw the bears really drag the market down. The bulls were able to pull up the losses, not nearly as great as the wick we see at the bottom of the candlestick for the afternoon. Now, lastly, as far as our indexes go, before we get to gold, we're going to go back to our 2-day chart, and we're going to take a look at, and for the record, the SPY was down 0.93%, so it was down more than the total market. And what was down the most was the Qs. The Qs was down 1.25%. And again, interesting, as we look at the Qs, even though it was down that significantly, we really have a spinning top. We already had a spinning open red box top back on the 12th. On the 16th, in fact, we're actually seeing the different lines that we've drawn get in the way. On the 16th, that 2-day candle, the 16th of May, is a doji, which means, again, lots of indecision. The market opens and closes, and we've got just about as up movement as we do down movement throughout the course of the day, opening and closing. So lots of indecision whenever you see a cross or a doji. And then we have a spinning top again, so lots of indecision. It is interesting to watch. It appears when we look at on the 2-day chart, as far as the Qs goes, and again, that's the NASDAQ 100, the technology stocks, the derivative oscillator's losing energy. So it's actually moving toward the positive, moving toward up movement, whereas the MACD and the signal line, the blue MACD and signal line, appear to be diverging, or at least running parallel to each, actually diverging over the course of the first day of the 2-day candle. So that's rather schizophrenic and interesting that you don't have all of your indicators working together. And people say, well, what does that mean? Well, if you can't find a signal that tells you what to do, it tells you to do nothing. Everything has to line up. We are not like professional traders on Wall Street who have to trade. We do not have to trade. Our number one goal when you're dealing with your virtual accounts is, first, don't lose money. Second, make money. But rule number one is always don't lose money. Don't do stupid stuff. Don't trade just because you feel like it, or just because you have time to jump into the market. It doesn't mean that you trade because you have time. The market's open every day. Well, that it's open, which is pretty much 5 days a week. You don't have to get in unless you can track it. You should never do that. Now let's look at what's happening on the short chart. Does it give us any additional information? It's interesting. It rolled over going up back on the 9th. and has continued to move up. It actually moved up for quite a while until the 11th and then tracked down. Then the market started moving up again, but it's in a confirmed up move on the MACD. The derivative oscillator gained all of its energy and peaked out on the 11th, and now the derivative oscillator is losing its energy. Again, hasn't yet crossed over going down. That could happen on the 18th, so pay attention to the cues. The only forewarning is when you look at what's happening on the 2-day chart, you are seeing that derivative oscillator. It is not our primary indicator. It is always the MACD, and it is still negative, and it is actually moving down. What can happen? Of course, you can always have the derivative oscillator move in the opposite direction. It hasn't crossed over yet. So again, if you find a good entry point on the 4-hour chart as far as making a move in an inverse Qs, QID is a double inverse. That's one. There are others. You might think about doing a virtual trade in that if it presents itself to you on the 18th. Now, lastly, and this is getting to be a long broadcast, I apologize, but whenever we get on rolls and want to share stuff, let's do it. Now, lastly, let's take a look at what's actually going on gold. Gold has been in a confirmed up move since it crossed over going up very weakly on the 2nd of May, and then it's tried its best to cross over going down, and it technically did cross over, apparently, throughout the course of the 17th, although gold was up 0.34%. Again, another chart that is hard to read, and if the chart's hard to read, then you don't trade it. We do see gold losing its energy as far as the derivative oscillator goes. It has crossed over going down on the 2-day chart, even though the price movement was up. We go by our charts, don't we? If we look at what's going on, we see that the 4-hour chart has crossed over going up as the 2-day chart has crossed over going down. When you have a schizophrenic reaction like that, you don't do anything with a trade in gold at this point. You just wait and watch as far as doing any kind of virtual trades. That is where we ended the market. Please be prepared and ready to jump in on a virtual trade if you see the market offering itself up to you. That is on our all 3 of our indexes, potential down movements there, and gold is just too iffy to try to do anything with at this point. You have questions, concerns, we love to hear from you. I was answering a lot of email today. Please let us know what you need from us, what kind of training would help you the most. Follow us on Facebook, YouTube, Instagram, Twitter, you name it. We are there for you. If you've not already signed up for and don't already receive our daily broadcast that you're listening to right now, you can do that at chartingwealth.com. When you go, and you sign up, you'll also receive our How to Read a Stock Chart video, in addition to the layout that you see on our videos. Those of you who are listening on audio, of course, we tell you what we are seeing, but we'll send you, regardless, you sign up for our podcast, we will send you the link to our layout at freestockcharts.com. Now remember, you need to go to freestockcharts.com first, sign up, it's free, for your own account. Then when you do want to have our layout, all you do is press the link. If you're already loaded into your free stock charts, it'll automatically take and give you our layout. It's that simple. Thank you so much from chartingwealth.com.